If you receive Social Security, use Medicare, or depend on retirement savings, one missed deadline or misunderstood rule could cost you hundreds or even thousands of dollars over time. The difficult part is that these mistakes rarely feel like mistakes when you make them. Claiming a benefit may feel like the responsible choice. Keeping an old health plan may seem safer. Taking money from your own retirement account may seem harmless. But the rules behind Social Security, Medicare, and retirement taxes are more connected than most people realize. In this video, we are breaking down 5 common retirement mistakes, why they happen, and what you can do to avoid them. The third mistake involves a Social Security tax rule that surprises many retirees. And the fifth shows how one large withdrawal can affect more than just your bank balance. This video is for general educational purposes. It is not personalized financial, tax, legal, or Medicare advice. Your best decision will depend on your own health, income, family situation, and coverage. With that said, let's begin with a decision that can permanently change your monthly Social Security payment. Mistake number 1: claiming Social Security without comparing your options. You can generally begin receiving Social Security retirement benefits at age 62. For many people, filing as soon as they become eligible feels natural. They have worked for decades, the benefit is available, and they may be ready to stop working. But claiming early can permanently reduce the amount you receive each month. Your full retirement age depends on the year you were born. For many current and future retirees, it falls between age 66 and 67. If your full retirement age is 67 and you begin at 62, your monthly retirement benefit can be reduced by as much as 30%. Waiting beyond full retirement age can increase your monthly benefit. For many retirees, delayed retirement credits add about 8% for each full year they wait after full retirement age, up to age 70. Once you reach 70, there is no additional increase for delaying retirement benefits. Here is a simple example. Suppose your benefit at full retirement age would be $2,000 per month. If your full retirement age is 67 and you claim at 62, your payment could be around $1,400 per month. If you wait until 70, it could be around $2,480 per month. That does not automatically mean waiting until 70 is right for everyone. A person who claims at 62 receives payments for 8 years before someone who waits until 70 receives the first check. The better choice depends on many factors, including health, life expectancy, other income, savings, employment, spousal benefits, survivor benefits, and how urgently the money is needed. So the mistake is not simply claiming early. The mistake is claiming without understanding the long-term trade-off. Imagine a retiree named Linda. She leaves her job at 62 and files for Social Security immediately because she assumes that is what everyone does. But Linda also has a small pension and enough savings to cover several years of basic expenses. If she had compared her options first, she might have decided to use part of that other income temporarily while allowing her Social Security benefit to grow. Or she might still have chosen to claim at 62 because receiving the money earlier gave her greater security. Either decision could be reasonable. The problem is making it without seeing the numbers. There is one more detail to remember. If you claim Social Security before full retirement age and continue earning money from work, the retirement earnings test may temporarily reduce or withhold some of your benefit if your earnings exceed the annual limit. That limit changes over time, so check the current rule before making your decision. Before filing, review your estimated benefits at different ages through your personal Social Security account. Compare age 62, your full retirement age, and age 70. If you are married, divorced, or widowed, also ask how spousal or survivor benefits could affect the decision. A few minutes of comparison can help you avoid locking yourself into a payment you did not fully understand. Now let's move to a deadline that can follow you for years if you miss it. Mistake number 2: assuming Medicare will start automatically. Many people assume Medicare automatically begins the moment they turn 65. Sometimes enrollment is automatic, especially for people who have already been receiving certain Social Security or Railroad Retirement Board benefits before age 65. But many other people must actively sign up. Your first opportunity is generally called the initial enrollment period. It lasts 7 months, the 3 months before the month you turn 65, the month you turn 65, and the 3 months afterward. Missing this window can create 2 problems. First, you could experience a gap in health coverage. Second, you could face a late enrollment penalty if you do not qualify for a special enrollment period. For Medicare Part B, the late enrollment penalty is generally 10% for each full 12-month period you could have enrolled but did not. In many cases, that higher amount remains part of your monthly premium for as long as you have Part B. This is where coverage from a former employer can create confusion. Some retirees believe COBRA or a retiree health plan allows them to delay Medicare Part B in the same way that coverage from a current job might. Generally, it does not. Coverage based on your own current employment, or your spouse's current employment, may allow you to use a special enrollment period. COBRA and retiree coverage usually do not extend that same protection. Consider Robert, who retires shortly before turning 65. His former employer offers COBRA, so he keeps it and assumes he can enroll in Medicare whenever the COBRA period ends. Months later, he learns that the Medicare clock did not stop when his employment ended. His COBRA coverage may have helped with medical bills, but it did not necessarily protect him from the Part B enrollment rules. This does not mean COBRA is always a bad choice. It means COBRA and Medicare have to be coordinated carefully. The safest approach is to begin checking your Medicare timeline several months before your 65th birthday. Do not rely only on what a friend, coworker, or insurance salesperson tells you. Use Medicare.gov or contact 1-800-Medicare. Explain whether you are still working, whether your spouse is still working, what type of employer coverage you have, and when that coverage will end. A short conversation before the deadline can prevent a coverage gap and years of higher premiums. The next mistake is different. You may be enrolled correctly and receiving every payment on time, but still be surprised when tax season arrives. Mistake number 3, assuming Social Security is always tax-free. A common retirement myth is that Social Security benefits are never taxed. For some retirees, Social Security is not taxable. But if you have other income, such as a pension, wages, investment income, or withdrawals from retirement accounts, part of your benefits may be included in your federal taxable income. The IRS uses a calculation that is often described as combined income. A simplified version adds your adjusted gross income, tax-exempt interest, and one-half of your Social Security benefits. For a single filer, if that amount is between $25,000 and $34,000, up to 50% of Social Security benefits may be taxable. If it is above $34,000, up to 85% may be taxable. For a married couple filing jointly, the comparable ranges are $32,000 to $44,000, and above $44,000. Here is the most important clarification. Up to 85% taxable does not mean the government takes 85% of your Social Security check. It means that up to 85% of your benefits may be included when your taxable income is calculated. The actual tax you owe depends on your total income, deductions, filing status, and tax bracket. Imagine a retired couple named David and Susan. They receive Social Security and 2 modest pensions. They do not consider themselves wealthy. Their money goes toward housing, groceries, insurance, medications, and occasional trips to visit family. During the year, they also take a larger than usual withdrawal from an individual retirement account to replace their roof. That withdrawal increases their income. When their tax return is prepared, they discover that a larger portion of their Social Security benefits is taxable than they expected. They did nothing dishonest or irresponsible. They simply did not realize that different sources of retirement income interact with one another. That surprise can be especially difficult for someone living on a fixed monthly budget. The solution is to estimate taxes before the year is over. Review your pension income, planned retirement account withdrawals, investment income, and any wages from part-time work. A qualified tax professional can help you understand how these amounts may affect your Social Security benefits. Depending on your situation, you may also be able to request voluntary federal tax withholding from your Social Security payments or make estimated tax payments during the year. Tax deductions and tax laws can change, so do not assume that a rule you heard several years ago still applies exactly the same way today. Planning ahead will not always eliminate the tax, but it can prevent an unpleasant surprise in April. Now let's talk about a mistake involving official letters, phone calls, and messages, and why both ignoring them and trusting them too quickly can be dangerous. Mistake number 4, ignoring a notice or responding before verifying it. Government notices can be stressful. A letter from Social Security, Medicare, or the IRS may concern a benefit adjustment, an enrollment issue, a request for information, a premium change, a tax matter, or a deadline to appeal a decision. Because these letters can look complicated, some people place them in a drawer and promise to deal with them later. That delay can be costly. Depending on the notice, missing a deadline could delay a correction, limit an appeal, interrupt an enrollment process, or create a problem with a payment. Even when the issue can eventually be fixed, resolving it may take time. But there is another danger. Scammers know that government messages create urgency. They may call, text, email, or send letters that look official. They may use real agency names, fake employee identification numbers, copied seals, or caller ID information that appears legitimate. Their goal is to make you frightened enough to act before you verify the message. Social Security may call people for legitimate business reasons, such as after someone applies for benefits, requests a call, or needs to update a record. The IRS may also call in limited circumstances, but legitimate agencies will not threaten to arrest you unless you make an immediate payment. Social Security will will not tell you that your Social Security number has been suspended. Government agencies will not demand that you solve a problem by buying gift cards, sending cryptocurrency, wiring money, mailing cash, or purchasing gold bars. If a message creates panic, slow down. Do not give the caller your Social Security number, Medicare number, bank information, passwords, or security codes. Do not click an unexpected link. Do not use a payment method chosen by the caller. Instead, end the call or set the letter aside temporarily. Find the agency's official website independently, sign into your secure account if appropriate, or call a number you obtain from the official government site. For Medicare questions, use Medicare.gov or 1-800 Medicare. For Social Security, use SSA.gov. For federal tax matters, use IRS.gov. Keep the original notice, write down the date you received it, and pay attention to any response or appeal deadline. If the notice is real but difficult to understand, ask a trusted family member, qualified professional, or official agency representative to review it with you. The rule is simple. Do not ignore an official-looking message, but do not trust it until you verify it independently. The fifth and final mistake affects how long your savings may last, and it can also change your tax bill and Medicare premiums. Mistake number 5, withdrawing money without a retirement income plan. While you are working, money usually arrives in a familiar pattern. A paycheck comes every week, every 2 weeks, or every month. Retirement changes that system. Now your income may come from several places: Social Security, a pension, retirement accounts, investments, savings, or part-time work. You have to decide how much to withdraw, which account to use, and when to take the money. Without a plan, it is easy to make one of two opposite mistakes. The first is spending too much too soon. The early years of retirement may feel like a long-awaited vacation. Some people travel more, help adult children, renovate a home, or make several large purchases at once. None of those choices is automatically wrong, but repeated large withdrawals can reduce the money available later, especially after taxes and market losses are considered. The second mistake is spending far too little out of fear. Some retirees avoid necessary home repairs, never take a trip they can comfortably afford, or live with constant anxiety even though their savings are sufficient. They do not lack money. They lack a clear plan showing how much they can safely use. Both problems come from the same source: making withdrawals without understanding the full picture. A large taxable withdrawal can have effects beyond the amount removed from the account. It may increase your federal or state income tax. It may cause more of your Social Security benefits to become taxable. It may also increase your Medicare Part B and Part D premiums through the Income-Related Monthly Adjustment Amount, commonly called IRMAA. Medicare generally uses tax information from about 2 years earlier when determining whether IRMAA applies. That means a large taxable withdrawal this year could lead to higher Medicare premiums in a later year. Imagine that Michael withdraws a large lump sum from a traditional retirement account to help his daughter make a down payment on a home. He expects to pay some income tax on the withdrawal. What he does not expect is that the additional income may also affect the taxable portion of his Social Security and his future Medicare premiums. The gift may still be worth it to him, but he should understand the full cost before taking the money out. If your income has fallen because of certain qualifying life-changing events, such as stopping work or reducing work, you may be able to ask Social Security to use more recent information when reviewing an IRMAA decision. Do not assume the higher premium can never be changed. Read the notice and check the official appeal or adjustment process. A practical retirement income plan does not have to be complicated. Start with 4 basic questions. How much guaranteed monthly income do you receive? What are your essential monthly expenses? Which expenses are flexible or occasional? And how will taxes affect withdrawals from each type of account? Then include irregular costs, such as home repairs, dental work, vehicle replacement, travel, and help for family members. Also check whether required minimum distribution rules apply to any of your retirement accounts. The starting age and details can depend on your birth year and the type of account, so use current official guidance rather than an old rule of thumb. A fee-only fiduciary financial advisor, qualified tax professional, or reputable nonprofit counseling organization may help you coordinate withdrawals, taxes, Medicare premiums, and long-term spending. Even a simple written plan is better than making every financial decision in an emergency. Conclusion: let's quickly review the 5 mistakes. Number 1. Claiming Social Security without comparing what you would receive at different ages. Number 2. Assuming Medicare enrollment will happen automatically or that COBRA and retiree coverage stop the enrollment clock. Number 3. Assuming Social Security benefits are always tax-free. Number 4. Ignoring an official-looking notice or responding before confirming that it is real. And number 5. Withdrawing from retirement savings without considering taxes, future Medicare premiums, and how long the money needs to last. None of these mistakes means someone was careless.
Retirement rules are complicated.
Social Security, Medicare, taxes, and retirement accounts are managed under different systems, but decisions in one area can affect the others.
The goal is not to make you afraid to use your benefits or spend your savings. The goal is to help you pause, check the rules, and understand the full cost before making an important decision. Here are 3 useful steps you can take after this video. Review your estimated Social Security benefits at different claiming ages. Confirm your Medicare enrollment dates and current coverage. And look at how your pensions, work income, investments, and retirement withdrawals may affect your taxes. Small checks today can prevent expensive surprises later. Which of these 5 mistakes surprised you the most? Share the number in the comments, and tell us which retirement topic you would like explained next. For your safety, never post your Social Security number, Medicare number, account numbers, passwords, or exact personal financial details in a public comment. If this video helped you, subscribe for clear updates about Social Security, Medicare, retirement taxes, and protecting your money after 60. Thank you for watching, and I'll see you in the next video.